You're watching the opening bell coverage here on the Open on BNN Bloomberg. I'm John Ehrlichman. And we have seen stocks taking a bit of a breather after the recent run-up. The S&P 500 is coming off 4 winning weeks. The TSX pulled back a little bit last week, but it's still on pace for its second best month of performance so far this year. And we mentioned earlier in the program that you've got some Wall Street strategists pointing to possible positive performance continuing through 2024. Deutsche Bank strategy team saying today it expects the S&P to reach 5,100 by the end of next year on cooling inflation trends, a rebound in corporate earnings. Strategists at Bank of America and RBC are also expecting a record high for the U.S. benchmark next year. Let's keep the conversation on what to be watching for heading into the new year with Kurt Reiman. He has more than 20 years of experience as an investment strategist. Kurt, great to have you back with us here on BNN Bloomberg. Appreciate the time.
Thanks, John. Good to be back on the show again.
What's top of mind for you right now? I mean, are you anticipating that you'll see some momentum for stocks into next year?
Well, I think we've had a pretty good month here in November. But looking ahead, I would say that there's a shaky foundation and a lot of tough questions. You just mentioned a number of positive forecasts for the S&P 500 and other global benchmarks next year. But there's a lot of questions that I think strategists, as they're thinking about the next year outlook, have to reconcile. I'm seeing a lot of debate on the question of hard landing versus a mini recession or a soft landing. Just how many rate cuts, if any, that we get next year, that was clearly one of the catalysts behind the run-up in stocks this month. Whether inflation eases back to target or if it remains sticky higher or maybe even turns into a periodic deflation next year. And then other questions about, what's going to lead in 2024. Is it value that comes back? I mean, I think some of the points that you raised earlier about some of these strategist forecasts, S&P 500 eclipsing 5,000, I would think that value would have to be part of that, perhaps. Certainly maybe moving away from this quality focus that's been in style for the past couple of years. And then just, I think, a big question next year, too, especially south of the border, is the presidential election cycle. And we also have, questions about whether all of the money that was in money markets, will that be put to work or not? But yeah, generally, I would say that the questions here that I've just outlined, I think it puts stocks on somewhat of a shaky foundation heading into next year.
So then let's talk about where money may flow. We were talking last week about if you're working off the assumption that we're at the end of an interest rate hiking cycle, and based on what you just said, I'm not sure you're ready to sort of declare us at the end just yet. But let's assume that the Fed at this point has brought up interest rates enough to address inflation enough that there won't be any more rate hikes at this point. I know it's a big if, but if you look at historically what happens to the S&P 500 over the year that follows, we showed for our audience last week, we might be able to show them again, that there are sectors that tend to have better performance than, for example, technology, which has been the star this year, utilities, financials, which we're going to be talking a lot about this week because the Canadian banks are going to report quarterly results, staples, healthcare. These are the kinds of industries that tend to, at least in that 12-month period, according to Canaccord Genuity, have better performance relative to other sectors. How do you feel about that?
Yeah, so as far as the central bank outlook, I do think that they've reached pretty well the point where rate hikes from here. I think that's really difficult. The question's more about whether we'll get the rate cuts that are priced in 2024. I don't think that's assured, and I think we also have to consider that if we do get rate cuts next year, and it's not against this backdrop of inflation reliably returning to target, which I think is, a really important point. Yes, it's fallen. Inflation has cooled. But I think central banks cutting interest rates next year, if they can't declare victory fully on inflation, would risk credibility if there are some of these more persistent or structural rigidities on the supply side that keeps inflation elevated or maybe it ticks up again. So that I'd actually be curious and wondering whether or not the rate cuts would be accompanied by something that's more sinister in the economy. And that makes the earnings picture next year with 11% earnings growth for the TSX, as well as for the S&P 500, I think that becomes a little bit more suspect. Now, I wouldn't rule out that we could get, low single digits, mid single digits earnings growth. I think that's reasonable. But I would argue that when you're looking at the consumer, when you're looking at the delayed effect of higher interest rates, when you're looking at interest costs that companies are bearing, higher wage costs, I think we need to think about a haircut to some of these earnings numbers for next year.
And then just specifically on what I asked about sectors in terms of, even if there's cautiousness for the equity market itself.
Mm-hmm. Yeah. So I mean, it's boring, but I'm happy to rely on the value that's coming from dividends. I would be looking for performance in consumer staples. Select areas within healthcare. Also, I would also look to utilities, but not solely. And I think this is going to be a big question next year. We've seen the inversion of the yield curve has started to move closer to less inverted. It's not quite at a neutral stance, but that steepening of the yield curve tends to be associated with a revival in value. I'm not seeing the catalyst. But let's just take energy, where oil prices have gotten clobbered.
Yeah.
This is an area where you're still generating ample free cash flow. If you look at price targets that analysts have for next year, it's the greatest upside relative to where current prices are. The sector's pretty well been left for dead. So within the value space, I think there are some interesting opportunities that investors may want to consider, and alongside that, the potential that comes from dividends.